And thank you so much for joining me here. Some China news to start off the show. Baidu ordered artificial intelligence chips from Huawei this year. This is according to two people familiar with the matter. And this is adding to signs that U.S. pressure is prompting Chinese acceptance of the firm's products as an alternative to Nvidia's. Take a look at this report.
Chinese tech giant Baidu ordered artificial intelligence chips from Huawei this year in what could mark a significant industry shift away from supplier Nvidia. That's how two sources who spoke to Reuters exclusively characterized the move, as it showed how U.S. pressure could lead some firms to find an alternative to America's top chip maker in the high-stakes AI race. One source said Baidu, which has become one of China's leading AI firms, placed the order in August ahead of new rules put in place in October by the U.S. government that tightened restrictions on chip exports to China, including those made by Nvidia. The order was relatively tiny compared to what Chinese tech firms have historically ordered from Nvidia, with Huawei's chips still seen as far inferior to Nvidia's in terms of performance. But they were the most sophisticated domestic option available in China, a source said. Baidu, along with Chinese peers Tencent and Alibaba, has been known to be a longtime client of Nvidia. It was not previously known to be an AI chip customer of Huawei. Analysts predicted last month that the U.S. curbs would create an opening for Huawei to expand in its $7 billion home market. The company has been the subject of U.S. export controls since 2019. Baidu and Huawei did not respond to requests for comment. Nvidia declined to comment.
Just a quick recap of markets. U.S. stocks rose on Tuesday with the S&P 500 and Nasdaq notching their longest streak of gains in 2 years. This is as a retreat in U.S. Treasury yields buoyed mega-cap growth stocks, and investors sought more clarity on interest rates from the Federal Reserve. Here's a recap of markets.
U.S. stocks rose on Tuesday, with the S&P 500 notching its seventh straight day of gains, the Nasdaq its eighth, the longest winning streak for each index in 2 years. The Dow ticked up almost 0.2%, the S&P 500 added nearly 0.3%, and the tech-heavy Nasdaq climbed 0.9%. Helping boost stocks, the benchmark 10-year Treasury note yield, which declined for the fifth time in 6 sessions on expectations the Fed is done with its rate hiking cycle. Adam Coons, chief portfolio manager at Winthrop Capital Management, said the Fed could cut rates by mid-2024, citing signs of weakening consumer demand.
The consumer has really tapped themselves out. You've seen savings rates depleted. You've continued to see credit card usage increasing, and then compound that with the fact that you're seeing delinquency rates for consumer credit start to tick up. There are now more and more signs that the economy could roll over. And so that is pushing the thesis that the Fed could end up having to cut rates sooner than a lot of investors anticipated.
The pullback in yields Tuesday helped lift mega-cap growth names such as Microsoft, up more than 1%, Apple, which climbed 1.5%, and Amazon, which gained more than 2%. Other movers included Uber, which rose more than 3.5% as the ride-hailing firm projected fourth-quarter adjusted core profit above estimates. Shares of software solutions provider Datadog surged 28% after raising its forecast for annual adjusted profit and revenue. But energy stocks fell on Tuesday as crude prices dropped more than 4% on demand concerns, hitting their lowest level since late July.
And Americans are piling up record credit card balances, and many are falling behind on those payments. Credit card balances hit more than $1 trillion during the third quarter, leaping by a record $154 billion from the year before. And this is according to the Federal Reserve Bank of New York's latest quarterly report on household debt and credit, which was released yesterday. The year-over-year increase is the largest since the New York Fed started tracking that data in 1999. Household debt increased by 1.3% in the third quarter, but a growing number of households are having difficulty wrangling that debt, which is increasingly more costly amid persistent inflation and high interest rates. The latest data also showed that the rate of households becoming delinquent on their credit cards was the highest since the end of 2011. And more discouraging news for potential home buyers. New research shows that this is the least affordable housing market since 1984, when Ronald Reagan was president. The report from Intercontinental Exchange shows more of a person's household income goes toward paying a mortgage than in recent years. High interest rates and the high costs for housing are to blame. The report shows the trend over the past 35 years was housing cost about 25% of a family's income. It now stands at nearly 41%. And a growing number of Americans are cracking into their retirement fund nest eggs to help pay bills. That's according to a report from Bank of America. BOA says the number of its 401k plan participants pulling cash out has increased by 27% since the first quarter of this year. That's over 18,000 people. And this is the highest level in the 5 quarters the bank has been tracking this data. The average withdrawal, just over $5,000. Now, despite high GDP numbers and low unemployment, Americans are clearly still facing a cash crunch caused by high inflation and rising costs of living. And they're not only tapping into retirement funds. It seems like the same report also found that the share of households newly delinquent on credit cards is at the highest level in a dozen years. 9 days and counting, that's how long Congress has to prevent a potential government shutdown. And so far, House Republicans don't have a concrete plan to keep things running. Here are the details.
Washington, D.C. is once again facing a possible financial collapse.
We certainly want to avoid a government shutdown. It's a dangerous time around the world right now. We recognize that, and we're doing our job.
Speaker Mike Johnson and GOP lawmakers in the House went through a series of ideas Tuesday, including a short-term spending bill through January 19th.
Many options that are on the table, and we'll be revealing what our plan is in short order.
If some Republicans in the House are against any sort of short-term spending bill, Johnson would need Democratic support, and that might be an uphill climb. A government shutdown occurs when Congress doesn't pass funding for the federal government without something like a short-term bill. That could cause many problems for the country, including the halting of construction projects and disruptions in food safety inspections. Johnson has until November 17th to deal with his conference, the Democratic-controlled Senate, and the Biden White House.
And a growing number of Americans are working multiple jobs. That's according to the October jobs report from the Labor Department. Here's what experts say is behind the federal data and who is leading that trend.
Juggling multiple gigs. The latest jobs report from the Labor Department shows nearly 8.4 million people had multiple jobs in October. That's the highest number since the start of the pandemic. And women appear to be leading that trend. The federal data shows nearly 6% of women worked multiple jobs in October. That's compared to 4.7% of men.
Our cost of living has almost tripled since 2020.
Experts say people may be taking on additional jobs to offset high inflation, which has been easing but is still painfully high for some households. Nonprofits like the United Way say inflation is outpacing wage growth, and that's making it harder for them to help families.
Wages do not reflect how important they are to everyday living.
Remote work is also offering more flexibility and opportunities for workers to manage several jobs from home. And there's also fear that layoffs could have people looking for supplemental jobs, but one economist says layoffs are actually historically low right now.
Companies are reluctant to lose their workers, and they're willing to negotiate even higher salaries to keep them.
U.S. employers added only 150,000 jobs last month. That's the smallest gain since June, signaling the economy is slowing and signaling that the Federal Reserve's action to tame inflation may be working.
The question is, how quickly is it working? We're still far from the 2% target, but inflation has come down quite a bit.
Rivian Automotive raised its production forecast for the full year by 2,000 vehicles to 54,000 units on the back of sustained demand for its trucks and SUVs. It's sending its shares up 4% in volatile after-hours trading. Here's the report.
Rivian on Tuesday raised its production forecast for the year by 2,000 vehicles. This target, now at 54,000 units, comes on the back of sustained demand for its trucks and SUVs. Rivian's upbeat forecast is a small win for the electric vehicle industry, which is reeling from two key issues this year. Higher inflation has hurt buyer appetite, and price cuts at market leader Tesla to stimulate demand. Last month, Tesla CEO Elon Musk said he was concerned about the impact of higher interest rates on car buyers. While smaller rival Lucid cut its production forecast on Tuesday, sending its shares down 4%. It now expects to produce up to 8,500 vehicles this year, down from an earlier projection of over 10,000. Rivian's chief executive told Reuters he was surprised at how much others have pulled back, and he's concerned it could create a vacuum of products in the EV market. Some analysts said that after sustained supply chain problems for Rivian, the EV maker may be starting to turn a corner after showing what one market watcher called resilience. To avoid slashing prices, it has taken elements of production in-house to reduce dependency on suppliers and slash costs. The automaker's higher-priced SUV sales have outpaced its lower-priced pickup truck, the R1T, boosting the average selling price of its vehicles. Rivian also announced plans to end its exclusivity deal to Amazon for its electric delivery van, opening the door for more customers around the world. The carmaker's Q3 revenue of just over $1.3 billion was in line with estimates, while its quarterly loss narrowed from a year earlier.
Nintendo said on Wednesday it's going to develop a live-action film of the franchise The Legend of Zelda in the Kyoto-based firm's latest push beyond its core gaming business. Here's more.
Nintendo is diving headfirst into live-action movies with a new real-life adaptation of its popular Legend of Zelda games. The company announced the project on Wednesday as their latest push beyond their core gaming business, trading on their popular characters with theme parks and movies. It saw runaway success with a Super Mario Bros. Film in April. It was the highest-grossing box office of the year, up until Barbie, and underscored the appeal of Nintendo's franchises. Now, in adapting its other blockbuster series, Mario and Zelda creator Shigeru Miyamoto says he's working with veteran Hollywood producer Avi Arad. Miyamoto says the two have been working on a Zelda adaptation for many years, though Nintendo, in posts on social media, said the movie will take time. It's a good time to spin up hype for a Zelda movie. This summer saw the near 40-year-old series' latest installment, Tears of the Kingdom. Nintendo says it sold nearly 20 million units by the end of September. The company also said Wednesday it had already sold 4 million copies of Super Mario Bros. Wonder, the first new Mario game in a decade that plays in its classic side-scrolling style, in the 2 weeks after its October release. While gaming remains Nintendo's core profit driver, in the first half of the current financial year, sales more than doubled in its mobile and intellectual property-related business, like its Super Nintendo World parks in Hollywood and Japan.
And staying with Nintendo, it said on Tuesday it's raising its operating profit forecast for the financial year ending March by 11% to $3.3 billion. This is as heavy-hitting franchises continue to attract gamers to its aging Switch console. Here's more.
Nintendo had good news for investors on Tuesday. The Japanese gaming giant raised its operating profit forecast for the financial year to March by 11%. Big-name games have proven so popular that Nintendo now projects it will make $3.32 billion in profit. Gamers have flocked to the aging Switch console this year. Nintendo sold 6.84 million units in the first half of the financial year, slightly up from last year. It's largely thanks to critically acclaimed games like The Legend of Zelda: Tears of the Kingdom. That heroic tale of Princess Zelda and the swordsman Link went on sale in May. Nintendo said it had sold 19.5 million copies as of the end of September, while another major title, Super Mario Bros. Wonder, launched last month. Nintendo's broad pop culture appeal was also helped by the success of a Super Mario movie. The game maker kept its full-year forecast for the Switch of 15 million units, though that would be a 16.5% decline on a year earlier.
And WeWork, the SoftBank Group-backed startup whose meteoric rise and fall reshaped the office sector globally, it sought U.S. bankruptcy protection on Monday. This is after its bets on companies using more of its office sharing space soured. Take a look.
WeWork, once the most valuable startup in the United States, filed for bankruptcy there on Monday. It had been a darling of Silicon Valley, worth tens of billions of dollars, but WeWork has hemorrhaged cash for years. In the second quarter of this year, 3/4 of its revenue went into paying for space. It has also struggled with corporate clients cancelling as remote work continued after the pandemic. WeWork's core business is taking long-term leases on buildings and renting the space out short-term. When it was flying highest, it courted big investors, most notably the Japanese tech giant SoftBank, and enjoyed backing from major Wall Street banks like JP Morgan Chase. But losses piled up as inflation soared, the downturn in the office sector deepened, and revelations of its founder Adam Neumann's erratic management style derailed WeWork's potential IPO attempt in 2019. SoftBank has dumped billions into WeWork to try to turn it around, but filing for bankruptcy shows it's admitting WeWork can't survive unless it renegotiates pricey leases in bankruptcy. Back in August, WeWork's website carried a warning to landlords that the company may cite the US bankruptcy code to rid itself of onerous leases. Some landlords have been bracing for a significant impact.
And Facebook owner Meta is barring political campaigns and advertisers in other regulated industries from using its new generative AI advertising products. And this is according to a company spokesman on Monday. It's denying access to tools that lawmakers have warned could turbocharge the spread of election misinformation. Here are the details.
Facebook parent Meta says it's banning political advertisers from using its new generative AI advertising tools. That's according to a company spokesperson Monday. With less than a year now until the US general election, Meta's move aims to cut off campaigns' access to tools that may turbocharge the spread of election misinformation on the world's second biggest platform for digital ads. Meta's generative AI ad products and virtual assistants, which can instantly create backgrounds, image adjustments, and ad copy in response to text prompts, were made available to a small group of advertisers in the spring. And a month ago, Meta expanded access to more advertisers. By barring access to it for political advertisers, Meta has made one of the industry's most significant AI-related policy choices related to political ads. As so far little has been said by big tech giants about safeguards on generative AI ad products released in recent months. Meta's top policy executive Nick Clegg said last month the use of generative AI in political advertising was, quote, clearly an area where we need to update our rules. He warned tech could be used to interfere in upcoming elections in 2024, especially content that moves from one platform to another. Meta's rival Alphabet's Google rolled out a similar image-customizing generative AI ad tool last week. It says it plans to keep politics out by blocking a list of political keywords from being used as prompts.
Elon Musk's artificial intelligence startup xAI will be integrated into his social media platform X and also will be available as a standalone app. He said this over the weekend. Let's take a look.
Elon Musk is just back from an AI summit in the UK. There he talked to British Prime Minister Rishi Sunak about the dangers posed by the tech.
I'm saying this is something we should be quite concerned about, because if the robot can follow you anywhere, then, you know, what if they just one day get a software update and they're not so friendly anymore? Then we've got a James Cameron movie on our hands.
Worries about Terminators aren't stopping him pressing ahead with his own AI plans, however. On Sunday, the billionaire said he would integrate his xAI startup into X, the social network formerly known as Twitter, which he bought last year. Musk launched xAI in July as a rival to Google's Bard and Microsoft's Bing AI. He says it is a maximum truth-seeking model, which will try to understand the nature of the universe. Musk says xAI has also launched its first bot, dubbed Grok. It's been available to all Premium Plus subscribers on X since Friday, and is meant to answer queries with a little wit. Musk says Grok has real-time access to information via the X platform, giving it a big advantage over rivals. X remains separate from XAI, but the two work closely together.